Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Tuesday, August 11th, 2026. It is 12:15 p.m. Eastern Time, so I'm starting the video. Here's what we're going to do in this one. We're going to talk primarily about one trade, but I'm going to segue into a few others because they're very much related. For those of you that know me or follow me for any period of time, I've got a lot of tentacles out there in the markets, a lot of kind of thread a lot of things together. In other words, the markets aren't just simple binary. Look at the chart of the S&P 500 and trade this. Of course, we do that, but there's a lot of interrelated factors in here. So, anywho, I threw the VIX trade out to you today. Even made an official trade, but just very, very clear that it is one of every now and then I'll post a catch a falling knife trade. Most people probably, think, what are you doing here? One example, a recent example, of course, was SpaceX. If you asked about it, a couple of subscribers and quite a few people I knew personally asked about SpaceX when it was coming out in the IPO, and my response to friends, family that asked, I said I wouldn't buy it with your money. I didn't short it, but I wouldn't buy it at the IPO, and I waited to right here, and so the VIX trade is something similar. It's a catch a falling knife. We went in there right off the lows. We quickly hit my first two targets. It never really went much below, ever so slightly undercut that low, stayed way above the stop. And so we milked. Remember, in the after hour session, we did hit exactly the top of my fifth target zone there. And so we milked by far the biggest run. This was the only other decent counter trend bounce was 16, almost 17%. This one here from where we took it to the top. If you use that post earnings strategy, set your good to cancel limit orders to be filled outside the regular trading session, you popped right in the top of T5 zone, got 18 and a half. So that was it. And so, went in, put another divergent low, and I've shared my thoughts on that. I think there's a good chance this one will take another leg down. Again, that's just my theory. And I addressed this one yesterday for those in it. But the point is, I'm trying to correlate the analogy to the VIX trade. Now, as I often say, and this is a saying, I didn't make this one up, in investing and trading, if you try to catch a falling knife, you can often get cut. You can even lose a few fingers. So that is what stops are for. Let me repeat that. That is what stops are for if you're going to catch a falling knife. Now, at the end of the day, yes, as with SpaceX, it was just intuition. I've been doing this for a long time. I kind of get a feel on a chart and just almost something that says, sit back. It's like that scene from The Hunt from Red October, and Captain Ramius is trying to navigate that canyon. If you guys remember that movie, Sean Connery playing the Russian sub-Captain Ramius. And they couldn't use their radar because they were being tracked by the Americans, and so, or sonar, I'm sorry, which would, of course, emit pinging sounds. And so he had to navigate it kind of by feel, kind of counting because he had gone through it. And so the VIX, look, now, first and foremost, guys, I don't just pot shot on trades. If I do it personally, I'm not going to send those out to you. I made a case. We're at support. We're at good support. This is where the VIX, you have a support range. You can see there's another level here about 1334 where we've had just two punches back all the way. This is 2024 back here. There's the year breaks, 2025, 2026. But you can see 99% of the time, this level here, where we just went long, has acted as support. And from there, especially when you get these divergent lows, you've had these big pops, and we've traded a lot of them. So, and I highlighted it here, but this is an official trade. And again, it's also pass on it if it's not your cup of tea. And I want to add something real quick before I forget. This is why I encourage you to go into the site if you're interested in anything that I post, any trade idea. If there's follow-up thoughts or any new developments on the charts, I'll add them in the comment section. So that's what I did here. And I just to let you know, as I should have added in the post above, the position size in any of the VIX tracking instruments, such as V/VIX, that's VIX futures, VXM for those of you that have smaller accounts or just cutting your teeth on trading futures. That's the mini contract. I forget what the multiplier is. It's just probably 1/10. I don't know. You can look it up. It trades on the same chart. So if you're going to trade VXM, you can use the same chart I showed you on VIX. It's just the micro or mini contract, whatever. And then I know a lot of you folks don't trade futures, don't have a futures account, don't understand the nuances of it. And then so I give you a staple. You can pick your poison. As I often say, you don't need the leveraged VIX C10s. On the contrary, this is what my follow-up comment was about. It should go without saying, but you should beta adjust the position size to account for the gain and loss potential. And what does that mean? I've come up with a calculator years ago, position size calculator. So, let's say your number's 10,000 in like SPY or QQQ. So the VIX has a much higher beta adjustment, at least 5 times. So I'll just put here, 5 times, 5 times. So you would do 0.2 beta adjustment to that. In other words, I'm just picking a round number saying the VIX, it can easily, when it starts rocking and rolling, go up 5 times or what the index does. So a 5-time beta adjustment, meaning you want to take 1/5 of position size, would be 0.2, 1/5 of, that's just 1/5, 0.2 in a fractional decimal form. And then that's it. So it's going to tell you that, you would take that, and then you can even, get real granular. I give you price targets. Let's pull up that chart. Let's just say for kicks and giggles. And I often tell you that the VIXY, because it is an ETF that's tracking the VIX, and it tracks futures and it rolls them over time, it's going to lose money. Even though the VIX has a floor, and the VIX comes to that floor, it's not a hard floor, it's a soft floor, but it never goes below that floor. You will over time lose money buying and holding VIX ETNs, even if you catch the explosive moves. So that's it. And so what I often tell you when we trade these guys, I like futures for tax benefits and liquidity and 100 other reasons. The leverage, if used responsibly, what does that mean? You can leverage up if you put all your money in a NASDAQ 100 NQ futures and you bet long or short on the market, or you put all in VIX. That's just pure outright gambling. You're going to blow up sooner or later. That's a guarantee. Nobody bats 1,000 in this game, not even the pros on Wall Street. So, but what it allows you to do is have a more diversified portfolio where maybe you're taking a VIX long as a hedge. Maybe you're long the markets and you want to hedge that with a long on the VIX, because if the stock market suddenly drops, if there's a credit event or something, a SWIFT, the VIX will pop. So you can use that as a hedge. Or maybe it's part of your portfolio. But again, you take it down the size a lot smaller. And on this trade, I told you my plan. Since it's catch a falling knife, what I mean by that, there's zero evidence of reversal. This is the ETF. The chart gets skewed over time. It's going to keep dropping. So you're not going to see that support zone I just showed you on the spot VIX. But remember, nobody can buy the spot VIX. It's just it's a theoretical index. You can only buy the derivatives that track it, such as VIX futures or these ETFs and ETNs that track the VIX futures, or options on the futures, or the futures themselves, of course. Those are the derivatives of the index. So, play was, start a position here. Again, it's gut feel, but it's not pure gut feel. Just like the SpaceX, I told you, the technical reason I saw a bullish engulfing candlestick forming on the 30-minute chart. Said, well, okay, we'll take it here. Here's our stop, and positive divergence, and boom, we got it. We traded with near impunity, the biggest, and even if you, like I said, if you didn't take profits on that first pop when it hit T5, it crashed back down. Afterwards, the next day, you would have been stopped out. So we gamed that first bounce. It's gone a little higher since, and I already addressed if you're still short. I still think I'll probably have another leg down. I give you a strategy, where to put your stops if you're still in it. But the official trade was stopped out. Okay, so that's it. So again, look, I just wanted to point out there was a technical reason. There's two objective times for me to make a case objectively, not just pot shot random. An objective long entry. Number one, when a security falls to support, if you believe that support is going to hold. And look, if you took this trade, by the way, you can also, you have the next support if it wants to punch through here. Let's just say the NASDAQ 100 wants to go up and make that marginal new high and then crap out scenario I've talked about. Still not my preferred, but certainly a possibility, a very likely possibility. And if that happens, take the S&P a little higher. Remember, the VIX is based on S&P put and call buying, and then you could go down there. So your stop, as I said in that post, is going to be commensurate with your price target. And I also watched the spot VIX. So what will happen on VIXY, should this trade start to pan out, there's a good chance I'm going to revise those targets and I'll get it out to you. In other words, I watch the spot VIX, I watch the VIX futures, and I watch the S&P 500, I watch the NASDAQ 100, I watch the market leading stocks. And if they're all falling to support, let's say SPY QQQ is falling to support around the same time VIX, the actual VIX, is hitting T3, and I think market's gonna bounce, we'll pull back, then I make, but we're still a little shy of the comparable target on VIXY, then I'm gonna get a post out to you and revise that target down. So just, and if I have time to do it, remember, when the VIX, here's the thing, guys, and this is why I do these videos. Again, it's the right side of the chart. I'm trying to predict what's going to happen in the future. You want the news? Subscribe to the Wall Street Journal or turn on CNBC. They're going to tell you what happened today, earlier, yesterday, last week. They're not going to tell you what's going to happen tomorrow. We try to do this, and you got to have a trading plan if you're going to trade the VIX, because when she wakes up, she moves very fast. If you ask me right here, because you didn't enter the trade here, and this is the next buy point, you break T1s, 1720, and the trend line comes in together. You get up here, I'm just going to say, look, it may still go up here. This is still a potential fit target, but I wouldn't chase. You're in no man's land. So that's my point being, you have to have a trading plan. And because when the VIX wakes up, sometimes it'll let you in, and sometimes if you're not already in, it won't let you in. If you wait just a few days too late, the move's over. All right, so that's it. So this is why I'm taking a shot. The case has been made there, and now let's get back to that post and break it down. I'm going to just go over what I gave you in the post, plus one other thing I want to throw in there. You can grab that for you. Okay, back to the site. I didn't finish up, but on that price calculator, you can enter your preferred target or targets, and it'll give you, your risk reward ratio, or you can key in the risk reward ratio. They're all enterable fields. So if you wanted to use a 2-to-1 or a 5-to-1 risk reward ratio, enter that, and it'll tell you where your stop should be. When I give you a maximum, and this one I didn't because there's multiple targets, and again, I'll leave that up to you whether you take it or not. But let me go back to these bullet points right here. Okay, so again, I'm not going to read the whole post because you already have it. But so these are kind of some of, but certainly not all of what I'm looking for. And I'm going to go over these real quick, step by step, so you can see what I'm looking for here. Let's start with XLF. I've been on financials lately more and more, and made very clear there's no sell signal. This is the daily chart, but let's take it down to the 60. You can see right here, before I leave the daily, this is the uptrend line I was talking about. This is the bearish rising wedge on the 60-minute chart. Let's go over to the 60. 60 just kind of zooms me in, if you will. So it's the uptrend line right here. It's coming off the June 3rd low. Nice, clean, multiple reactions. Divergent high, just like this was a divergent high, you get a little correction. Push to marginal new, still divergent high, another correction. Marginal new, still, it's all the same divergence. It just keeps getting bigger and bigger. Trend indicator is still bullish. It's above the 0 line right here. But if we get a breakdown, you can see where these are all potential targets. XLF starts to fall. XLF will likely take the S&P 500 down with it. The S&P 500, SPY on the 60 already broke down a little minor trend line right here. But bigger picture, you know, way back here when we peaked, just like the NASDAQ 100, we got a sell signal there. The market broke down. The SPY broke down, I think it was a day or two before QQQ, and that's where we entered the QQQ short. Remember, we're still profitable. QQQ has not made a new high like the S&P 500. For those of you looking, is that a bull flag? Maybe, maybe not. Doesn't really take a flag pattern. The bull flags go down like that, but whatever. You want to call it a bullish pennant, which looks like this and could break out maybe. You know, that's why anything's possible. But way back here when we peaked, I started giving you this divergent high question marks, and I've crossed that out because that's checked, saying that any new high, because the indicators were lagging, we have the same situation in QQQ, except it hasn't happened yet. Any new high in SPY would guarantee to be a marginal new and still divergent high, and as such, I put a high rate of failure. And then in that post, I told you, see, this is that support zone. There's your previous all-time high, right? We broke down. We had a multi-month trading range. We recently broke out. So this is a breakout to new all-time highs. And if you fall back below here, I have it as a support zone. It's not unusual when you break out. When you come to back test a breakout of a new high, sometimes they'll come a little bit down through there, and that's normal, and it will just wash out some tight stops. But anything, again, it's more of an incremental, not binary thing. Once you start falling back below that previous high, it becomes more apparent to more and more traders that the breakout has failed. Okay, so this would be one of the things that I would look for, and this holds a lot of weighting because this is the S&P 500. Remember, Mr. QQQ can go to the moon and back, but it has nothing to do with the S&P 500. Or the VIX, because the VIX tracks put and call buying on the S&P 500. And here's the QQQ. There's our short entry. Like I said, we're still profitable. Even if you didn't gain book profits, this was when my first target was hit on the 60-minute T2 right there. And this is where our fourth and final target is, right around that 636 level. So, and this is the most recent sell signal I gave you here when I did the video comparing the top back in late 2021 to this current top. The price action is just so similar. It's almost uncanny. But again, that was a whole video, so I'm not going to get into it now. Spend an hour kind of going over the similarities. But the story of QQQ is this multi-month trading range. This is July, June, May. We're still in this big sloppy, choppy trading range. But if I didn't maintain and still think we're going down here, we're not going to get there in QQQ. You have my word on this because of the overlap with the big weightings. Even though the NASDAQ 100 doesn't have any financials, it still has the same. The S&P 500's largest sector is the technology sector by far, and QQQ is mostly tech. So bottom line, that's it. We need SPY to go down. It will if QQQ falls here. They do move together, not in lockstep, but in near lockstep. And then, of course, XLF. That's the last to me, the final holdout. And like I said, the only thing that kind of foils my plans, if you will, or where I think things are going, assuming that LX does break down, which I have a pretty high degree of confidence that it's coming. I told you in the recent video last week that I suspect the breakdown will probably come this week. We'll see. Maybe it's next week. All I can tell you is when we get a solid break below this trend line, that's the sell signal. And then that is one thing that will increase the odds that the S&P is going to go down because the financials are the second largest sector. We got to look at the lead sled dog, JP Morgan, still above trend, right? This is the biggest financial. And just need some others to go with it. So, all right, guys, that's it. So it's just a starter position. It's speculative. And like I said, pass if that's not your cup of tea. Let's go back to VIX. Oh, no, let's go back to the post and look at the other things I'm watching here that will play into this, I believe, or may play into this. Okay, so I already covered. Let me change my drawing tool color here so you can see. I already covered XLF, what I want to see there. I covered SPY. And now let's talk about these, well, of course, and the downtrend lines on the VIX charts. Obviously, that'll help. I covered that. Let's talk about the 30-year bond. Again, something that I think the stock market's playing a game of Russian roulette with more than one bullet in the chamber. And that's TYX, a yield on the 30-year. And of course, I watched the 10-year as well, but the 30 is already broken out. Again, been beating this like a dead horse, but only because I think it's that important. And I think the markets are dismissing what is a potential big risk. We still have, by the skin of our teeth, about flat line divergence, roughly equal highs on the indicators, higher high in price. And look, if the stock market were to break down, the VIX starts rocking. Let me put it this way. The VIX isn't going to rock, at least not to those upper targets. Maybe my first early targets, but it's not going to hit those higher targets, T3, T4, without a substantial correction in the stock market. You get that, you usually get a flight to safety bid in Treasuries. However, the market has kind of been flipped on its head in recent years. We saw that in 2022. The whole 60-40 rule, what I'm referring to in my former life as a stockbroker / financial advisor, that's the old golden rule of investing. Diversify, but for long-term, for a long-term investment portfolio, 60% of your money in stocks, 40 into bonds. Of course, there's the age rule, where typically the younger you are, take the number 100 minus your age. So if you're 30 years old, you should have 70% of your money in stocks and only 30 in bonds. And if you're 20 years old, 80%, because you have a longer time horizon, right? So you get to approach retirement, you're 50 years of age, you should be half stocks, half bonds. So either way, but that blew up in 2022 because both the stock market had a bear market and bonds fell. And so what I'm trying to get at here is, we can't rely on the old rules. There's been so much heavy-handed manipulation in the bond and credit markets, and even the stock market, that a lot of the old rules just don't apply anymore. And plus, it's also a function, guys, of the budget. The huge deficit spending that we have in this country, our GDP, the debt ratio. Not just us. Japan's in even worse shape, as most of you probably know, and that's why there's math, intervention going on right recently between with both the U.S. and the Bank of Japan, trying to prop up the yen. To really, it's the takeaway, and I posted it, is this is trying to foil this. Ultimately, it helps this because. And again, I address this. It's documented, and you can read up on it. If that continued to happen, the Bank of Japan has to support the yen. They're the biggest holders of U.S. Treasury bonds, and so if we didn't help them, they're going to sell our Treasuries to prop their yen up, and it's going to cause our Treasury yields to spike up. Besant had pretty much no choice but to step in and aid them. And so, look, that's, again, the markets seem to be nilly-willy about it. And, and I guess it's because they've seen in recent decades, every time there's been a crisis anywhere, whether it's the financial crisis, COVID, or the regional bank problems in 2020, the market came to the rescue with one gimmick or another. Not the markets, I'm sorry, the governments. Central banks and or Treasury. All right, so that's it, guys. What I'm trying to say is, there's probably a drop in the stock market could bring Treasury yields back down due to a flight to safety bid, but then equities are going down. So I've made very clear I don't have a position in Treasuries. It's something I'm watching, and it's an incremental thing. And here we are. We're flirting with new. We just popped and made a new, again, not multi-year high, but a new multi-decade high, and we're just, again, a spitting distance from doing it over. If you want to look, if you don't have TYX, you can just look at TLT. That's the ETF that tracks the long bond, and you can see it's within spitting distance of making a new, again, not multi-year, but multi-decade lows. It's an ETF, so you can't go back as far as you can go with, and it's not exact. ETFs have expenses and fees, so that's why I, usually give you the TYX because that's the actual yield. An ETF, again, isn't the 30-year Treasury bond. It is an ETF that holds 20 to 30-year bonds because it's going to have varying maturities because they're trying to keep their expenses down. They can't, every time you buy a 30-year bond, a year from now, there's only 29 years left on maturity. And so if they keep selling that, they're churning, they're creating excess of fees. So they'll hold them down for a while, and they make sure they don't let them roll past, get past 20 years. So you can look it up, whatever the average maturity is in there. It's probably going to be about 25, 26, 7 years. I don't know. All right, so that's it. But so that's why I look at TYX, and that's what we're looking at here. And again, you can see financial crisis, 07 to 09, the dot-com crash from 2000 to 2002, and that's where yields have now taken us back to just before those two events have both occurred. So it's and again, I'm not probably getting off topic here because I've explained the fundamental impact many times. This isn't even a debatable topic. The market's just banking on the fact that we're seeing some soft economic or employment numbers recently, and the Fed's going to cut. But again, it's laughable because the Fed tried that, and they tried cutting back here, and long-term rates went nowhere but up. And so now the news, I'm reading the headlines, and the media's spinning it as bullish because the job market's finally starting to really soften. We had some downward revisions on the previous numbers, and then we missed on the last one. And yet the market's taking that as bullish news because, they were pricing in a good chance of a cut by the end of the year, and now that lessened the chance, of a hike, and the weak jobs number diminished that. And again, that's insanity because historically consumer spending has been accounted for 2/3, almost 70% of GDP. Given in recent years, there's been a disproportionate amount of GDP contribution from the whole AI circuit jerk bubble, not just the chips, but all of it, the data center spending and all that. And again, God forbid, I'm sorry to talk the bearish talk, but God forbid we have a recession with a lot of job layoffs, and it's all intertwined. If that happens, who's going to spend the $200 a month on Perplexity computer? Because that's what it costs. If you want Perplexity Pro, which I'm going to get to in a second, it's $20 a month. Perplexity computer is a more advanced model, $200 a month. Gemini starts out, I think it's $100 and something a year. I don't know. I have both subscriptions. The Gemini's rolled into my cloud storage plan for an extra, I think, $120 to get the Pro. And but my point is, guys, these are subscription-based models. They're useful, even if you don't use them for your business. I find them super useful, just projects around the house or just looking into stuff. But just like everything else, Netflix, Paramount Plus, all these extra subscriptions people don't really need. There's going to be a lot of people that are ponying up for those now because their stock portfolio is up, their house is up in value, and so they're spending. And again, it goes back to economics 101. I'm a business major. I don't have to tell you, it's simple economics. When the job market craps out, people lose their job, they're going to cut back on discretionary spending. And that includes, the first thing to go are excessive subscriptions, like I just mentioned. Maybe they drop from the Netflix premium plan with no commercials in 5 streams for their whole family down to the one with the annoying TV commercials and only 1 stream. Or they cut Netflix out completely, and say, you know what, I'll just wait a few months, turn it back on, binge a whole series, and turn it off. That's what's going to happen in the next recession. So where I'm going with that's going to be a death blow to these, the whole AI bubble, because these companies are banking on, and they're fighting right now for market share. Who's going to be it? It's ChatGPT this week is the best model. Next week it's Perplexity, and then it's Gemini, and of course Claude for code, but then there's this new one, they just keep leapfrogging each other. I'm getting off on a tangent, but let me get back to the other point I wanted to make here. So, yes, Treasury bonds could break down. Wouldn't surprise me if they do, but I have been persistent and consistent for years. Shortly after we bottomed here, that this was most likely. At first, it was a theory, and then it became fact that this was the end of a nearly 50-year secular bear market that began back in the beginning of early 1981, a secular bear market in interest rates, falling rates, which was I don't think you'll find an accredited economist out there that will argue with the fact that we saw the biggest bull market in history over this period because falling rates are stimulative to both economic growth and the stock market for no other reason because investors are forced into, including but not limited to public and private pension funds, insurance companies, companies that normally are very happy to lock in a lot of their money at 6, 7, 9%. That's what they were getting all the way up here at about 16, 17% on Treasury bills back here, or Treasury bonds, 30-year. And so as rates fall, it forces more and more money out of those guaranteed. I guarantee half the people listening to my voice right now, you would say, Randy, if I could get 7% locked in on Treasuries, especially if you're getting close to retirement, you would sell a lot, if not all, of your stock portfolio right now to do that. And we're headed that way. So again, it was a theory back here, but it is fact now. It's not debatable. We can sit here and argue all day long, but a definition of a downtrend is higher highs and higher lows. And we've also taken out the very clear and what was a well-defined price channel until you got these these were the rounds of quantitative, the initial round during the financial crisis, quantitative easing, excessive intervention by the banks to bring rates down, and it worked till they overdid it. They did too much of a good thing, and then it let the genie out of the bottle, started causing inflation. Now they've lost control of the long end of the yield curve. So again, we've talked about it often. They can take rates down to zero at the federal funds rate. It's just going to cause ultimately rates to go even higher because it's going to spur more inflation, and it's just going to hurt the economy and the consumer because you and I don't get to borrow at the federal funds rate, unfortunately. Whether you buy a car, a house, take out a business loan, you're going to borrow based on what the 5, 7, 10, and even 30-year bonds are yielding. That's the sad fact of it. And God forbid, let's not even get in the fact that credit spreads have been so extremely tight lately. Get a blowout in credit spreads. Treasury yields could pull back in, sit tight. But again, you don't get to borrow at the same rate that the federal government borrows, and nor do corporations. So right now you still have that Goldilocks period where credit spreads are in my opinion, way too tight. And then if they start blowing out, wow. Okay. All right, guys. So those are fundamental ramblings, and do what you want with that. But let's just get back to our trade. So again, as I'm going to just tell you, it's a gut feel thing, but it smells like the next credit event might not be too far off the horizon. So the first thing that'll happen, and it hasn't happened yet, the financials will break down. XLF. So I'm watching those closely. This is the way it works. Whether it's the regional banks, which I watch closely, whether it's the some of the big banks, a niche sector, specialty financing, you got private equity, private credit. You guys know my eyes are on all these things, BIZD. Wherever it's going to come from, the financial system is extremely complex and intertwined. But one thing I did, unfortunately, I can't post the reply. It's a violation of their terms. I told you I use Perplexity as one of my AI models, their premium subscription. And I encourage you to do this. You can run it through ChatGPT, whatever you use. And I started out because you guys know my thoughts on Bitcoin. I'm not married to this scenario, but We have an active short trade, which I continue to maintain additional downside targets. We already hit our first target. That was after previously going long. I won't summarize it. You can go back. We've gamed this one, like a world champ. Longs, shorts, all the way down. T3 hit, shorted there, went long. That was a short there. We went long here. Up first target. Again, second targets were canceled. The second two. And stops were raised to keep us in the trade, and that was highlighted as an objective short entry add-on. So was that. Hit our first target. I've acknowledged the positive divergence, but also that the trend is bearish. And I have what are pretty much, doomsday targets, which I'm still maintaining. And again, I'm not married to it, okay? I promise you that if strategy does this, strategy is the proxy for a Bitcoin trade, that I will not be short through that, right? I'll still keep my short on. I still expect this to happen. And just remember, the reason I added T4, it was initially a potential price target. I made official because if we start doing this, strategy in itself will become a vicious cycle for Bitcoin. And you can look into that, do it yourself. So long story short, I did a prompt that let's just say this plays out. Because there's 101 places the next kind of credit event can pop up. But I prompted provide a list of institutional funds included but not limited to public and private pension funds, hedge funds, etc., with the largest exposure to Bitcoin, directly or indirectly, including but not limited to derivatives such as strategy, which is MSTR. And anyway, I went on the reply is way too long to read, but it steered me into, and it gave me a nice little chart of where the risks lie, and it ranked them as far as, systemic risk or idiosyncratic risk. And for example, certain things like Mara, which are one of my, Mara and some of the other Coinbase, we've traded those as what I call Bitcoin proxies. And so those obviously aren't going to do well if crypto crashes. But one of the, of course, if crypto goes down, it's a vicious cycle. But where this thing ended up steering me to is one of the biggest systemic risks posed is on Tether, which is a stable coin. And it gets real interesting. Again, I wish I could post this stuff, but it says it's against their terms and agreements, strictly prohibited sharing the results you get there on a public source like this. But again, if you have it, prompt that in, and then, or you can just say, if you start with that prompt, the unwinding, just assume an unwinded Bitcoin. Just prompt that in there that, let's say Bitcoin goes down substantially from current levels. If you want to define what that is, 30, 50%. But again, I've already made the case that I believe because of the leverage and the amount of Bitcoin strategy and some others hold on a leverage model, it will begin a vicious cycle of selling that will then selling begets more selling. So therefore, if we get to T3, it's going to increase the odds that we're going to get to T4. So now we may never do that. If we don't, then hey, maybe this is something I talk about a year, 2, 3, 4 years from now, the same kind of scenario. Or we go long, as we've done before, just like we went long right here when we hit my third and final target, right? I gave you, at the time, 3 targets. So we'll game this whatever way the charts tell me, unless, my gut tells me to override what I see, which is in this case. I've fully acknowledged the downtrend line, the bullish falling wedge, positive divergence on both Bitcoin and strategy. I'm just, call it bias, call it what you want, intuition, right or wrong. I'm going to stick with this, and I'm not taking that breakout because it's a breakout I think is going to fail. And again, it's for both technical reasons as well as fundamental reasons. All right, but anyway, so it goes on to pretty much say, how Tether, is a stable coin, and a lot of trades are cleared in Tether, and it talks about their reserves, their excess reserves, and it gives you the math on this. It's kind of cool. It's really super interesting. And Bitcoin isn't the largest, but it's a very large part of its reserves. Gold's considerably larger. But what happens is they have a buffer, and it talks about that buffer. So if Bitcoin drops, then the reserves start to go down, and may have to sell to boost reserves. So they may have to also sell Bitcoin, or they may have to also sell gold and short-term T-bills. It lists what they keep as their buffer. But then that does pose a systemic risk, and they say, these things can happen like wildfire. So if those that are using Tether, it's a stable coin for, clearing, paying for trades and all that other stuff, all of a sudden they see Bitcoin going down, and they anticipate, which is, what's in here well documented. And again, I wish I could explain it to you. It's a little bit nuanced and detailed. It can happen so fast where you start seeing money being pulled out of Tether, pulled out of the stable coins like that, because of the risk that they have that they may blow through their reserves and then cause a vicious cycle of selling, which breaks that, breaks the buck, so to speak. And then that could quickly cause, and it could spill over into the other reserves, such as gold. Like I said, that's one reason I'm a little skeptical of gold and the breakout. I mean, we caught the run so far off the bottom twice, really, using GDX as our proxy. But that's again one of their biggest reserves too on Tether is gold, and so if you do see Bitcoin start to spiral down, especially accelerate in selling, that could spill over again into gold and some other things as well. So I didn't list that in there, and that's why if you go back to my initial post here, I was very clear. There's a lot of things, and it may be something I'm not even watching. All right. So not necessarily limited to the following, but I just wanted to cover that. And again, here's the end of the day I just did. I'm going to stop it here. We're at 42. We're coming up on 42 minutes into the video. And, it all comes back to the VIX and the market dropping suddenly out of nowhere because you can't understand it. They say the job market's so stable, and these earnings on these big, they just keep spending on AI. We just had all the majority of the Mag 8 companies. NVIDIA is an outlier. I think SMCI is coming up to report either today or, in the next day or two. I saw that's coming up. And some people can't get their heads around what could take the market down. And I know, kind of that lean to that henny penny, chicken little sky is falling thing. At the end of the day, what I'm getting at it, guys, this is one trade. One simple trade, one beta adjusted trade, and it either plays out or not. And it's not even at this point in time a full trade, a full position. And that's even not counting the beta adjustment down. Once this is where I take it to, when I say a full position, doesn't mean my entire account, but when I start to see some of these or any other developments, particularly this, again, the VIX not going to go anywhere meaningfully to the upside without the S&P 500 going down. And the S&P, as I said, will not go down without the financials going down and tech going down as well. Because I've also given you these, again, I think they're easy concepts to understand, but multifaceted, because we could see a correction in the financials and all of a sudden tech starts to rally and picks up the baton. Well, tech has 2 times the weighting of the financial sector. So you could see the financials drop 20%, and the tech sector only has to go up 10% to offset that 20% loss. Do you follow? So these are the things that I'm looking at, but that's it. So let me wrap it up here, get the video out to you, and that's it. Like I said, it's just one of many trades, and pass on it if it's not your cup of tea, or wait for those higher probability sell signals like I've mentioned, including but not limited to. The big ones would be XLF and or SPY, given these aforementioned sell signals, or if the Treasury bonds just continue to keep popping the previous highs and keep moving to new highs. I promise you sooner or later, in the 10-year as well, the market will get the memo. It's ignoring this right now. It's writing it off with the strong belief because they've been bailed out for so long. It's like the parent that has that kid that they've spoiled from the get-go. You guys know who I'm talking about. You all know somebody that pampered their child It always bailed them out every time they got into trouble in school or trouble with the law or whatever. They came in, mommy and daddy bailed them out, and now that kid can't even wipe their ass as an adult because they were pampered. And so the market is come that came kind of came that same mindset where no matter what happens, how big the credit event is, banks failing, private credit, private equity, Bitcoin blowing up, the Fed will come into the rescue, and or the federal government, Treasury Department, and they will save the day. And maybe they do it again on the next crisis, maybe not. Like I said, the difference this time around is that we've broken out to new multi-decade highs, and not just U.S. Treasuries. We saw it happen recently in the Japanese bonds, and UK gilts, all these major companies. So that is the difference this time. They are, in my opinion, much more restricted. They don't have unlimited amount of arrows in their quivers anymore as they did when we had little to no inflation. And that gave them carte blanche to print money and take rates to zero or even negative rates like they did in a lot of European countries. All right, I'm going to wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.